How's everyone doing tonight?
Great.
Okay,
Fantastic.
great. How many of you are Hapco members? Awesome, good. And how many of you have been through a Jumpstart training program? Okay, awesome, good. I just want to get an idea. It's great to do this. Thank you, Greg. It's great to do this with Hapco tonight and have our two organizations come together. I've been a Hapco member for 37 years now. And for those of you who have been through Jumpstart, you've heard me mention Hapco. It's a group that's worth joining because, I'm not a big member type person, but when you have the chance to join something and have them put out a newsletter and information that you really must have if you are going to buy, particularly buy and hold properties, but even buy and sell, that's a group you want to join. So I strongly recommend them. Let's see if we can figure this out.
Just keep clicking all the way through.
Okay,
Yeah.
great.
And there you go.
Okay, thank you. So thank you all for coming tonight. We are going to be talking about financing, and particularly we're going to spend some time on the BRRR method. How many of you are experts at the BRRR method? Okay, good. So we got some ground to cover. This is great. So first of all, I'm Ken Weinstein. I'm president of Philly Office Retail. We are adaptive reuse real estate developers. I've been in the business 37 years. The building you're in right now is typical of the type of projects we do. We took a vacant, deteriorated school building from 1876 and made it into office space. My offices are on the third floor of this building, and there's a nonprofit that uses the space during the day, but we have a special arrangement where we can use it for events and meetings like this in the evening and weekends. I wear a lot of hats. I'm the founder of Jumpstart Germantown, Jumpstart Philly. We now have 15 Jumpstart programs around the country. As I mentioned, I'm president of Philly Office Retail. We currently own and manage around 800,000 square feet of commercial, residential, light industrial space. A lot of projects around this Wayne Junction area here. I also mentioned, just because we're talking about financing, I learned a lot about financing when several years ago I was the founder organizer of Valley Green Bank. We were a community bank based in Mount Airy, have since sold to Univest, but I learned a lot about underwriting, a lot about lending when I founded it with people more experienced than I was. So tonight we are going to talk about, I'm going to give you a little overview of Jumpstart since some of you have not been through. We're going to talk about finding your financing, identifying sources of financing, how to secure a loan. As I mentioned, we'll have an emphasis on the BRRR method. And then we're going to talk about investor-friendly financing and talk about the Jumpstart Philly program. Why do we do it? Why do we do what we do? And then Angie's Williamson, who is the executive director of Jumpstart, is going to come up and talk to us in more detail some of the information about Jumpstart, how to qualify, what we look for, what we don't look for, how to apply, and all that stuff. So I don't want to talk at you for the next 30, 40 minutes, so feel free within reason to raise your hand and take some questions along the way. At some point, might need to move through it, so I might say hold the rest of the questions till the end, but I would rather have a little back and forth with you and hear and follow a little more of what you want to cover, not what I want to cover. Does that make sense?
Yes.
Okay, awesome. So real quick, and I'm not going to get into a lot of detail here, but Jumpstart philosophy. We're not your normal get-rich-quick scheme training program, as I like to call it. We believe in triple bottom line investing, meaning you can improve your community while you make money and while you create wealth locally. So we are very much with Hapco in terms of promoting scattered site rehab, providing what we call NOAA. Noah is my youngest son, so I always like using the term, but it's naturally occurring affordable housing. What does that mean? That means when you buy and renovate in what we call a middle neighborhood like Germantown, you're creating affordable housing. If you do that in Center City, nothing wrong with it, but it's less affordable, as you know. You're gonna buy more, your rehab cost is gonna be higher, and so on. My passion, my personal passion, that got me into this business 37 years ago is blight removal. So that's something that we emphasize in Jumpstart, because I believe that everyone has the right to not live next to a blighted property. We believe in changing the face of development by encouraging diversity. I don't know how many meetings I've been to over the years, 95% of the room, maybe higher, white men. That needs to change, and that is changing. And more than 85% of Jumpstart graduates are either women or people of color who have been historically left out of real estate development. We believe strongly in growing the pie by sharing resources, that you don't just keep information and resources to yourself, that you share with other people, which is what we're doing tonight. We believe that you can reduce gentrification by building wealth locally. I have no problem with outside developers coming in and doing their thing, but if we can get local residents to improve their own neighborhood, you can improve and create and keep the wealth locally, which reduces gentrification. And then last but not least, you can be a good neighbor while developing. Don't go into a project, don't stay underground. Go knock on doors and talk to people. Tell them why you're doing what you're doing, explain it. They may not know. They just see you as a developer. Developers are bad. Help them understand why you're and how you're improving your neighborhood. So how are we doing that? We have a training program. We have a developers network, which is really what we're doing here tonight. Training program, 16 hours. We give you a mentor at the end of the training program. We actually have a session starting next week for 5 weeks, and we'll be doing this again in January, February, somewhere around there. And then last but not least, loan program, which is what we're going to be focusing on tonight. So what do we teach in the training program? We teach what we call the 7 jump steps of real estate development. A lot of people know 1 or 2 of these steps. If you're a contractor, you know about construction. If you're a realtor, you might know about sourcing properties. Not a lot of people are on top of all 7. So we are trying to show people all 7, makes them more well-rounded developers. But again, focusing tonight on number 4, which is finding your financing. So let me jump right in. Any questions so far? That's just background. Yeah.
I mean, when you say, you had sent the email out as far as loan size, when you get to multifamily, and you say as you add units, you add the loan size to the loan. I just want you to, can you dive more into that?
Hold that for Angie,
Okay.
who's going to get into the details of the loan program. But yes, that is a recent change we made, which is really helpful. Yeah.
That's the reason why I came.
Yes.
How does your program compare to hard money and typical banking finance?
Angie's going to also cover that. We're jumping ahead a little bit. But we are a hard money lender. But she'll go over the details, it'll show you. And we're in short term, which we'll go over shortly. Yeah.
Question.
Yeah,
Where does your Jumpstart program happen?
it happens right here.
Okay.
We did go virtual. We had 125 graduates at a time during the pandemic. But we're back down to 65 at a time in this room. And we do site visits to construction sites, but it runs 16 hours over 5 weeks. Yeah.
Is it full for this?
It is full, unfortunately, starting next week. You can get all the details, jumpstartgermantown.com. You'll see the training program. But would love to see some of you who have not been through sign up for early next winter. So identifying funding sources. You want to think about your equity contribution now. What's the equity contribution? That's how much you have to put into the project. So for example, when Angie goes over Jumpstart Philly loans, we're going to put up 85%. Well, you still need to put up 15%. Don't wait until you have a property in front of you, and don't wait till you're applying for a loan to figure out where you're going to get that 15%. Start looking now. Maybe you already have it in the bank. Good for you. Maybe you go to family and friends, which is what I did when I got started 37 years ago. Maybe you get a loan, a line of credit on your home, or some sort of personally guaranteed line of credit. That's ideal, by the way. That should be all of your goals. To take the equity in your house if you own one and go get a line of credit, because you can write a check on that line of credit and only pay interest when you get that line of credit or when you use that line of credit. So you want to think about that. You want to find, maybe you want to find a investor or a dollar partner. A little harder if you're a newbie developer. To be honest, if I have cash in the bank, I have choices. I'm going to want to invest with an experienced real estate developer, but maybe you have a friend who would like to be an investor. And then last but not least, we're starting to see some crowdfunding. Kickstarter, some other sites, ways to raise money if you can present yourself well. In terms of the non-equity contribution, meaning banks, where are you going to get your funding from? Well, non-traditional funders like Jumpstart Loan Program, which is now available citywide. Other hard money lenders, Spring Garden Lending, just had a nice article in the Inquirer. The founder of Spring Garden Lending, by the way, was also my co-founder on Valley Green Bank, so we learned in the same place and in the same way. But there's others, Magnum Loans, a gentleman named Christian Best, who teaches in the Jumpstart program. eMortgage Capital, Mark Brown, who also teaches in the Jumpstart program, are good alternatives. But be careful who you go with. Find someone who's going to help you along the way, which is what we try to do with the Jumpstart Philly program. There's also other alternatives. There's financial institutions, traditional banks, people like Alex Richardson with American Bank. Again, Alex teaches in the Jumpstart program. Credit unions, great place to go. Small banks, they make decisions in the back room, not in some other city, which is ideal. Community development financing institutions, they call CDFIs, and then government loans, which may have lower rates, but more difficult to access and will take longer. So be careful if you decide to go in that direction. But you want to get creative. You want to, if you don't have a lot of cash, you might need multiple sources, but be careful. It's something a lot of jump starters have learned. Don't use credit cards, because it will kill your credit, and then you won't be able to get your permanent financing. So do be careful. Okay, so any questions on that? Think about your sources now and think about what direction you're going to go in. You could always change direction, but you want to find your equity contribution now. Finding your financing, these are just some notes that I've learned over time. Bankers are not scary. Your earnestness and your goodwill will go a long way. And most lenders will be able to go step by step with you, especially if it's a smaller bank, a CDFI, a credit union, a small bank, a hard money lender. But that took a while for me to realize that, I always thought, oh, bankers are your enemy, keep them far away. But it doesn't have to be that way. A good banker should be able to help you through the process. Be prepared. Review the list of items you need for a loan application. Assemble them ahead of time. Don't wait for banks and loan officers to tell you what they need. Put it together ahead of time. And if you go to the Jumpstart Germantown website, if you go to our workbook on page 36, we have a page that tells you everything that banks are looking for. So think about putting that together now. It'll make you look really organized and together, which is the next point. Being organized, professional in your presentation, and know the lingo. even if you're new to real estate development, go to the Jumpstart workbook, go to the glossary of terms, and memorize them. Understand them and memorize them. If you go into a bank and you say to the loan officer, oh, what's LTV? You keep using that term. They're not going to lend you money. You have to know what LTV is. What is LTC? What is, you have to know these terms. You have to look and sound like an experienced real estate developer, even if you're not. And be sure to follow through. Don't drop the ball. These bankers are very busy. And if you don't follow up, they're not going to follow up. So be careful. Get involved with appraisals. This is something I learned the hard way. A lot of people say, oh, I'll just give the lockbox code to the appraiser. They'll walk in the property. They'll figure it out. No, don't do that. Put together comps for the appraisers. Anticipate their questions. Walk through the property with them. Think about what they're going to ask. Make sure you sell the house and sell the neighborhood. Most appraisers, and I can say this over and over again, don't know the neighborhoods they're going into. They're in Germantown. They're looking at Mannheim Street. They've never stepped foot in Germantown. They're from Phoenixville. So you want to tell them what schools are nearby. Tell them the attributes of the community. So sell them on the property. Yes?
That is such a great point. Going through a traditional mortgage, like just an FHA or just conventional loan, it felt like you weren't even allowed to be there, like at the appraisal. Like they work with the seller and then the mortgage company, they schedule it. So I didn't even think that was an option. But that's so smart because I feel like, especially in a lot of these neighborhoods, they underappraise the properties.
All the time. Right. So if they don't allow you, they don't allow you. I don't know the FHA rules, but most times when you ask and you say, oh, yeah, there's no lockbox there, I have to be there to let them in. Well, you just got an entry, whatever it takes. But you want to be there. Yes? Okay. So this, but we typically are allowed to. Yeah, and each bank may be a little different, so it's hard to know. But at the very least, even if you can't be there, send comps to the bank and ask them to forward it to the appraiser, whatever it takes. But don't just assume they're appraising in your interest because you're going to lose money. And we're going to get to that when we get to the BRRRR method. It's even more important. Feel free, by the way, it's not easy, but feel free to appeal an inaccurate appraisal. There are some really bad appraisers out there. There's some good appraisers. But I remember a property up the street here, 5847 Germantown. We got this terrible appraisal. And it was close to $1 million under value. So it wasn't a house, it was a commercial property. But I went to the bank and just said, I'm sorry, they're way off base. Here's my comps, here's my assumptions, and you know what? Not only did they adjust it and give me another $500,000 on the value, they promised to never use that appraiser again because they were that far off. So feel free to challenge it. At the very least, you'll sensitize the bank to what's going on.
Good work on you, Ken.
Yeah. Everything's negotiable. Again, it took me years to realize this, but you get a rate, say 6.5%, which is the typical rate right now. Don't just say, oh, okay, great. I'll decide either I'll take it or leave it. No, go back to them and say 6.25%. Very often they'll give you another quarter point. Don't get ridiculous. Don't say, 5%. They're not coming down 1.5 points. But feel free to push them. Feel free to negotiate. Just because they give you a number doesn't mean that's what you have to live with. Think about the rest of your terms. Is it a 3, 5, 7, 10-year loan? What do you want? Negotiate it. So typically, for almost all my 37 years in real estate, you want a longer term. You want to lock in long term. So I'm always taking the typical 5-year and asking for a 7 or 10. Well, for the first time recently, I went back to them and said, well, the rates are really high right now. Can you give me a 3-year? So actually, I locked in at 3 years instead of the 5 because most of us believe that rates will be going down. Or better yet, don't just go to one bank. Go to 3 banks, get bids, play them against each other. Nothing wrong with that. You can still go back to your preferred bank and say, hey, you know, Tompkins Bank gave me 6%. Can you match that? Because that's your preferred bank. Nothing wrong with that. You just want to keep your bankers honest, right? That makes sense? As I already said, become familiar with the general terms, loan to value, loan to cost, debt service coverage ratio, which is typically 1.25 or better. Amortization is typically 20 or 25 years. Typically, it's a 5-year balloon, meaning that's the term of your loan. And typically, the recourse is that you have to personally guarantee the loan. I'm not going to go through what all those things mean, but if you don't know, go to the glossary in the Jumpstart Germantown workbook, or Google it and look it up. Okay? Does that all make sense? Great. So we're going to jump into the BRRRR method. And it sounds kind of silly, and a lot of you, it looks like in the room, know a whole lot more than I knew 37 years ago. Because I didn't know, first of all, I never heard of the BRRRR method, but I didn't even know that you could do this for probably the first 5 years I was in real estate. And so I call it the biggest secret in real estate, is the BRRRR method. I'm going to hold off right now on this example, but I want to go through an article, recent article in Rocket Mortgage that I think talks about the BRRRR method very well. The BRRRR method is buy, rehab, rent, refinance, and repeat, right? It's a mouthful. But you'll better understand it once I go through it. What you want to do is get a cash out refinance so that you can fund future projects, right? You can take the money out and use it for college education or vacation, but if you want to get into real estate, if you want to grow your real estate portfolio, you're going to take cash out on your projects and you're going to use it for your next project so that you can produce more and more income and wealth. To be clear, and I always forget to go over this, this is only for buy and holds. This doesn't work for buy and sell. So if you buy, rehab, and sell a property, you're never refinancing it. You're getting cash, of course, when you sell it, but you're also paying taxes on that, which I'll go over in just a minute. The BRRRR method is meant for buy, rehab, and hold properties so that you can refinance and continue to hold them. So what do you want to do? You want to buy a property, you want to rehab it, you want to gain equity in that property. What do I mean by that? Meaning if you buy it for $50,000 and you put $100,000 rehab into it, right? You're in for $150,000 now. You want it to be worth $200,000. You just gained $50,000 in equity in the project. I'm going to be honest with you. It's more difficult right now in this tight real estate market to achieve what I'm talking about, but far from impossible. It's very possible, but there are some markets that I have been in where this is like a no-brainer. You just keep doing this and keep doing it. You will then rent out the property, obviously, unless you're committed to affordable housing and purposely want to keep it lower, you're going to try to maximize your rent. You will then do a cash out refinance on the property. You'll convert your equity, in the example I just gave you of $50,000, you'll convert that into cash by taking out a larger mortgage and borrowing more money than you normally would. Nothing wrong, you can play it safe and go get, in the example I gave you, go get a mortgage with a value mortgage at 75% of the 150,000 you've put in, and you're playing it safe, but you're not getting cash out. If you want to get cash out, you're going to try to get an appraisal at 200,000, and you're going to get 75% of that in terms of financing. Does that make sense so far? Yeah.
One thing I think you don't really go over is it's two appraisals. It's the sales side and the income side. Like if it's a 3-unit building, it's not going to be appraised the same way that something sold around the corner, so right?
It's not two different appraisals. Are you asking what the criteria is for the appraisal? Is that what you're asking?
It's like an income reducing.
Yeah, so a typical commercial appraisal, and commercial meaning multifamily, there's a lot of different definitions, so each appraiser in each bank is a little bit different. But let's assume, for example, it's a 10-unit building, so it's obviously commercial. Typically, 50% of the appraisal is based on comps. It's similar properties in an area maybe half a mile to a mile away, right? The other half of the appraisal is going to be based on the income approach, which you calculate before debt service how much it's going to cast off, or what your positive cash flow is, hopefully, per year, and then you divide that. I'm getting too into it, but you divide that by
10% cap rate.
Yeah, hopefully better than 10%, but let's say an 8% cap rate, and that'll give you the value. So what a typical commercial appraiser does is then averages those. So the comp method may come out and say the property's worth 500,000. The income approach might come out at 600,000. They'll give you an appraisal for 550. That's typically how it's done. Okay, but that's good. I'm glad you asked that because I'm not going over that. I just went over it. But that's good information to know because you have to understand how the appraiser is thinking, right? You want to work them on a cap rate. The lower your cap rate, the higher value comes out. So you want to, most buildings like this around here have a 7 cap.
That's pretty good.
Sound like, no, I'm just saying it. Sounds like, yeah, you know what I'm talking about, right? Didn't I sound it?
The lower the cap rate, the higher the value.
That's right. So, okay, so the BRRR method, yeah, we just talked about the appraisal. There are other methods of buying. Again, Angie is going to get into using hard money lending like Jumpstart Philly, but you can also use a home equity line of credit. You can use another hard money lender. You can use cash if you have it. Nothing wrong, particularly for the buy and rehab, of using cash if you can do it. We do a lot of that. And then once the property is stabilized, which we'll talk about in just a sec, you have a tenant in place, stabilized, then you go out and get the permanent financing, okay? So that's another alternative method. You need to know what the after repair value is, the ARV. So again, you want to look at comps, what are other properties in the area selling for. There's what they call the 75% rule, meaning you in general want to buy and rehab for 75% of the ARV, 75% or less. Why is 75% so key? Because banks are typically lending 75% LTV. So if you're buying and rehabbing for more than 75%, you're not going to be able to use the BRRR method. If you're buying and rehabbing for less than 75% of the ARV, then you can use the BRRR method and get cash out, okay? That's key. So you want to calculate that. In terms of the rehab, of course, you want to increase value. You want to update your kitchens and bathrooms, your curb appeal. You want to do what it takes to get a higher ARV within reason. That should be your goal. Refinancing. You want to refinance your investment property. first of all, make sure you're talking to lenders who are offering cash out refinances. Some lenders, particularly in tighter markets like this, won't do that. They'll say, yeah, we'll refinance it. We won't give you a cash out refi. So make sure you're talking to a lender that offers cash out refi. A lot of lenders will talk to you about seasoning. How many of you know what seasoning is? Great, other than cooking. That's not what I meant. But you want to, some lenders don't require seasoning, and I'll explain what that is, and some of them do require seasoning. Seasoning is once you get a tenant in place, there are lenders that want to see that tenant pay rent on time every month for 3 months, 6 months, maybe 9 months. So again, you want to find out from the lender, do you require seasoning? Ask these questions ahead of time so you don't go down that road and think you're really close to doing a cash out refi and find out they want a 9-month seasoning. And you want to refi before that because you're paying relatively high hard money rates, right? You want to get to your permanent financing as quickly as you can. Complete the rehab faster, find banks that require no seasoning, get to the finish line as quickly as you can and take out the higher price hard money lending. Does that make sense? You got seasoning? Yeah. Okay. I didn't know what seasoning was for, I don't know, first 10 years in the business. Nobody told me. You know, where were you guys? Make sure you know all of your costs, your appraisal costs, your additional fees, your closing costs. You want to know all that up front. So again, it's questions you want to be asking the bank. And then repeat. And actually, I'm going to tell you a key thing. I was saying to Angie earlier, I read this article in Rocket, and I can't believe they totally missed this. What this is this doesn't just happen once. What I'm talking about happens every 5 years. And let's assume that, why do I say 5 years? Because typical loan term for a commercial loan is 5 years. So you'll have a chance again after 5 years to get a new appraisal on the property. Your rents probably went up during that period of time. Hopefully the neighborhood that you're in has improved and you can expect a higher appraisal. Okay, in a tough market that doesn't happen as much. In a really thriving market, the appraisal values go up very quickly. And you'll have a chance again in 5 years when that loan becomes due, when your permanent loan becomes due, to do this all again and take more cash out. Okay, so that's how you should be looking at it. Sometimes, by the way, don't get too disappointed. Sometimes you can't use the BRRRR method initially. Maybe you did not buy in rehab because of construction costs were too high, unknowns, and you didn't buy in rehab for 75% or less of the ARV. So you may need to wait 5 years to do this, but then 10 years out, you can do it again. And that's what has funded my projects over time. We just keep taking cash out. So keep that in mind. Pros and cons of the BRRRR method, building equity, you know, we talked about that, so that you can do your next project. The other big thing this article missed is one of the biggest benefits of the BRRRR method and cash out refinancing is it's tax-free. So you have a choice, right? You can, if you need cash, you can either sell the property or you can go do a cash out refi and take cash out. What's the difference between the two? Take a cash out refi, you don't have to pay capital gains on that refinanced amount. That's really significant. What's the tax rate right now? Greg, what's the tax rate on capital gains? 20%? Okay. So you can avoid that 20% if you do a cash out refi. If you sell, you're going to have to pay capital gains on that. The cons, you know, what happens if you go to refinance, you qualify for less money than you originally planned, you may need to take cash out of your pocket. So do be careful. You can always change plans, by the way. We have a lot of jump starters who intend on doing buy and hold properties, and when they see that they didn't get the right appraisal, and they're not going to be able to use the BRRRR method, they sell the property because they need the cash now for whatever reason. And that's okay. Always know your options. And sometimes the BRRRR method takes some time. You got to find tenants, you got to season, as we said, the property. You have to refinance. It's a process. So it may take longer than you want to do. Okay, that's the BRRRR method. Any questions? Great. Yeah.
What's the favorite publication of that article?
Yeah, good question. It is June 8th, 23, so it's recent.
Do you have any emails or notes, particularly?
Yeah, is there a way we can send out this article to everybody here?
As long as Hapco gives us the registration, yes.
Okay. Hapco, is that good? Okay, we got a thumbs up. So that's how things work. Yeah, we'll send it out. Yep. Okay. That's what I got. So this is sort of overkill to now go through this, but in this example, I'm buying at $75,000. I'm renovating at $125,000, so I'm in for $200,000. But my ARV is $280,000. So I take out a 75% loan, or $210,000. I just got $10,000 out of the project. Plus, the benefit is I have a monthly cash flow. How do I know I have a monthly cash flow from this project? If I didn't have a monthly cash flow, the bank wouldn't have done a cash out refi. So I know that there is a cash flow, positive cash flow out of this project, okay? So moving right along, the objectives of the Jumpstart Philly loan program, we're trying to provide loans that banks don't want to provide. We realized this when I started the program 8 years ago. We were training up folks and then realizing we can train up folks all we want, but if they can't get bank loans, they're never going to be able to get into real estate development. So that's why we started the loan program. Why do banks not want to do these loans? And I learned this even at a community bank like Valley Green. Banks don't like to do relatively small loans. Our average loan in Jumpstart, for example, is $122,000. A lot of banks won't do loans under $500,000 or $1 million. Why? Because it's the same amount of work as it is for a $100,000 loan versus a $1 million loan. My team knows how much work it is. So, secondly, because they don't loan to newbie developers. They want to see that you have 3 projects under your belt in general. And by the way, it's not just the banks doing this. It is the regulators, state and federal, who are over their shoulder saying these things. And again, I know that from the bank. So it's not always the bank policy. It's sometimes the regulators telling banks what to do. And thirdly, banks don't like to do construction loans. Why? They're messy. You know, you have draw requests, a lot of processing. They just don't like to do that. They love doing the permanent loans, and they'll do a relatively small permanent loan, but they don't like to do the construction loans. So that's why we do it. We're trying to remove blight from neighborhoods. Like I said, that's my passion. We're what we call more than a bank. You know, we do a little hand-holding. End of the day, it's your project. We are not going to step in and do it for you. But that being said, we have really good trained inspectors who are also mentors in the program and can help you along the way if you have questions. If you don't have questions, that's fine. We're fast and friendly. Angie's going to kill me for saying this, but we can close a loan even in as short of a week if we had to. We don't like doing that, and Derek doesn't like doing that. But, you know, we can act quickly. Why? We don't do appraisals, right? Most lenders are doing appraisals. That's going to take 3 to 5 weeks. What seller is waiting around for 3 to 5 weeks, right? So we can make you look like a cash buyer by acting very quickly. Our rates are high relative to traditional bank rates because they're hard money lending, but you'll find out that very quickly that we have the lowest hard money lending rates anywhere, partly because we're mission driven, so we don't need to maximize profit. And now I'm going to bring up Angie, who's going to get into the fine details and answer some of the questions that already came up.
Thank you.
Yeah.
Thanks, Ken. All right, hi, I'm Angie Williamson. I'm the director of Jumpstart Philly, and I'm going to quickly go over what our loan can do for you as an investor. So before I get into the details of our loan, just a quick overview of what our loan is and what it isn't. So we are for acquisition and construction. So we're not for turnkey. If you see a property that looks great, doesn't need any renovation, our loan would not be for that property. We are for investment properties, so we're not for your primary residence, we're not for home ownership, it's for investment properties. As Ken said, we're short term, so you're not gonna refinance with us, you're gonna get us at the beginning of that BRRR process. We're 12-month financing, and then you go and refi or you sell the property to pay us off. And we do up to 85% LTC, so that's loan to cost, not LTV, not loan to value. So we're not for someone that doesn't have any money and is looking for a zero down kind of loan product. So you would need to have at least 15% of the total project cost. So what you're purchasing it for and what those construction costs are, 15% of that total would be needed for our loan. And we're interest only. And the great thing about our loan is that you're not actually making any interest payments until the final draw. So during construction, you do not need to make payments to us for our loan. So we're really proud of our track record to date. Over the last 8 years, we're almost at 400 loans that we've closed, $47.5 million that we have committed to these projects. And as Ken stated, our average loan is $122,000. Doesn't mean that's our max, but that's our average. So it can be those smaller projects that maybe don't need a huge renovation or you can get really cheap. We can definitely help you out. So getting into the details of how you can get a Jumpstart Philly loan. So the eligibility, we're very excited that we are now citywide. So the property itself must be in the city of Philadelphia. You, as the borrower, do not need to live in the city of Philadelphia. We are open to anyone, so you do not have to be a Jumpstart graduate. However, there is a perk. If you are a graduate, you get a 0.5% interest discount. But if you're not, come on, we'll still look at your project and finance. So it is not just for Jumpstart grads. We get that question a lot, so we want to make sure everyone knows it's for anyone who finds a property in the city. We do focus on residential, so that is our bread and butter, but we will look at mixed use. We typically want to see that the investor has a little more experience because it's a more complicated process. But they would also need to have a residential component if it is mixed use. So it would need to have some sort of residential unit involved. And then we will do a credit check and proof of funds. We're really low doc. That's pretty much all we're going to ask in addition to that loan application. For that credit check, if you're going to hold the property and then you're going to need to refinance, we do have a minimum credit score of 680. But if you're going to buy and sell, we don't have a minimum credit score. We're just looking at your credit to see, have you paid your bills? Are you going to pay us your interest? But there's no credit minimum if you're going to do a buy and sell. And then proof of funds, back to that 85%, and you're bringing that 15%. So we need to see, do you have that 15%? So we're going to just ask for a bank statement, something like that, that shows you've got the money that you can do to do this project. And also, jumpstartphilly.com. All of this information is there also where you can apply. So if you any other questions, I'll definitely answer here, but later on, definitely check out our website. So our loan amounts. I think someone over here had asked about our loan amounts. So we do have, for single family property, the maximum loan amount is at $350,000. but then we can increase that by $50,000 per unit. So if you have a duplex, that could be $400,000, up to maximum of $750,000. So we could not do a loan of $775,000 for a 10 unit, something like that. So $750 is our max per borrower. That can be spread out over multiple loans though. You could have 5 loans as long as the total of all of your loans with us does not exceed $750,000. So those are new increased limits that just came into to play in the last month or so. And then we also have affordability requirements. So Ken had mentioned NOAA, naturally occurring affordable housing. So we want to preserve affordable housing in Philadelphia. So we're looking to see if you are renting the property, we want to see a maximum rent as detailed in the chart here based on the number of bedrooms. And then if you're selling it, we want to see that your project numbers work under these maximum sales price, again, based on the number of bedrooms. And then our loan costs. So everyone wants to know what your interest rate is. And ours changes the first of each month based on our cost of funds. Currently, for those graduates, it's 9.95. If you're not a graduate, it would be 10.45%. As Ken said, it's a little bit higher. It's higher than a permanent loan. But if you look at other hard money lenders, we're definitely very competitive with our rates there. We have a $1,500 loan commitment fee. That is not an application fee, no application fee at all, but once we have approved your loan and we're ready to move forward and you want to move forward, that's when that fee would be paid. And then a $275 just flat legal fee. And then our sort of points, we have a 2% loan fee that is not due up front, but is rather rolled into the loan. So as I mentioned, we have that 12-month loan term. Sometimes things happen and it might take a little longer, and we understand that. So we do have extensions, but they come at a cost. So we have a 3-month extension and it'll cost 2% of the loan to extend it for 3 months. And you can have 2 of those. So you can extend it for a total of 6 months, which would mean your total loan term then would be 18 months. All right, and that I went very quickly through. So I'm sure there are some questions. Yes. Oh, yes.
So you mentioned that there is an affordability for rent and for sale. With the sale, obviously, you will scale this selling it, you can see what's the sell for. But for the rent, is there some type of fee restriction that's included in the property?
There is not. We just need to see when you are submitting your pro forma to us that the numbers work with that rent amount. So, but there's not anything in perpetuity or a certain number of years that rent is required. So you're going to submit a pro forma to us that has all your project numbers. That's what our loan approval is based on project numbers. I mentioned we're low doc, so we're really looking to see, is that project going to work? And one of the things we look at is to make sure that the rent is within these ranges here. Yes?
Do you loan for commercial properties?
We do not currently loan for commercial, except in that mixed use scenario. So if it's like a storefront on the first floor and residential unit upstairs, we could do that. Yes?
Do you have any seasoning requirements on the down payments?
No, it can be money that you got in your bank yesterday. So, yeah, that's fine. Yes, in the back in the yellow.
Do you still require 15% to acquisition costs?
That's a great question. Thank you. So if you already own the property free and clear, we can look at a 100% construction-only financing. So you would not need that any money down because your equity is in the property itself. So, yes?
And that 2%, does that make it 11.9% or is that already in the loan? So it's 9.95%.
The 2% fee?
Yeah.
So I guess technically, how would that?
I'm sorry, I missed it.
Does the 2% fee kind of increase the interest overall?
Actually, is it 2% plus the 9.95 or is that 2% already in the 9.95?
Oh, no.
Well, no.
It's in addition.
Yeah.
2% is a fee that we charge for processing.
It's of the loan
on
amount.
The back end. It's not paid until you either refi or you sell. But no, it's not part of the 9.95.
So it's
Right.
okay, so 11.9.
Yes.
Those rents there, those are the maximums that you can charge for 1 bedroom or 2 bedroom?
That is the current maximum.
As long
Yep.
as you're under that number, you're good.
Yes. Yes.
And again, only as it pertains to the pro forma, we're not enforcing after the fact.
Okay.
Yes.
You're purchasing a property in an LLC and you have more than one owner. Whose credit score do you run?
So for LLCs, we do look at every member of the LLC's credit. So we will want to see all of them. Again, if it's for buy and sell, there's no minimum score. We're just taking a look. And then if it is for the...
Score going down. And then if you...
We actually don't do a pull. So we don't. We actually have you submit to us a recent credit report from one of the 3 bureaus. So, yep. I think there was another... Yes. Yeah.
Kind of going off the LLC point, would you guys encourage those who are doing like harmony loans and things like this and like flipping and even if you're keeping to put it in an LLC instead of your individual?
So it's really a personal decision, and we go over this in the Jumpstart training program. But it's as a matter of like kind of keeping your assets separate. Yes, I think most attorneys would encourage you to create an LLC. And most of our borrowers do it with an LLC. We don't require it. We will lend to individuals. Everyone does have to have a personal guarantee, whether you have an LLC or you're borrowing as an individual. But yeah, typically it's a little safer to go with the LLC. Yes.
If you own a property and have a very small mortgage, like $5,000, can you pay off that mortgage and then get money?
You could, yeah. You can pay off that mortgage and then come for 100% financing for construction. Yes.
The maximum rent rate right here, is that applied for multi-use and like a duplex as well, or is it double that number here? So like
For the sales price, or for the sales price or the rent?
Well, the rent.
So the rent is that would be per unit. So if you had a duplex and it was a 2-bedroom unit and a 2-bedroom unit, each unit could rent for that $1,660. Yep. Any other? Yes.
So I see the maximum loan amount per borrower is $750. So if I use that 1 year doing projects, that's my max? I can't.
If you pay it off, you can come back and more. It's just at one single time you can't have more than $750. But we've definitely had repeat borrowers that have done 7, 8 loans with us and have exceeded, a $750. But as long as there's not that amount out at one time. So once you pay us off, you can come back and get another loan. Yep.
One more question. Do you have like a network of, if you have someone or people in the neighborhood who are looking to sell the property, which you would be interested in finding an investor from the program to put themselves in a position to do the renovation on the property?
So we don't have a specific network for that, but we do have a Facebook network where there's a lot of sharing of resources and people who have investment properties to sell. We'll put them up there and things like that, but not a specific for that exact scenario. So, yeah. Any other? Yes.
It's for any neighborhood in Philadelphia. It's not neighborhood specific.
Correct. This is citywide now. We used to be just in specific neighborhoods, but now we are very excited to be in the entire city of Philly. So. Yes. The Jumpstart workbook? Was that the question? It is available online. Yep, yeah, Jumpstart, you can get it to either of our websites. So our training stuff is all on jumpstartgermantown.com, and then on Jumpstart Philly is our loan information. But in the resources of either page, there is a link to the Jumpstart workbook, and you can download it it's totally free. Yes.
Is there any cost to belong or get the materials from Jumpstart?
No, so to go through the training program, there is for Jumpstart Germantown is a $125 fee. All of our materials are open source online. So the training workbook that we use, the PowerPoint slides, all the resources and stuff you can look at your own pace and leisure. The courses, so we have our Jumpinars, which are sort of our continuing ed, for lack of a better term, and those are all available. There's usually video and sometimes also podcasts. But the training program, the full 16-hour, there would be a fee to view that 16-hour. It's a $75 fee to view that. Yep. Any other? Yes.
So in the process of buying a property, normally when my clients are buying property, getting a pre-approval from a hard money lender or a bank, is that something that you provide?
We do. We require a loan application first because we are project-based, so we still want to make sure the project numbers work before we're issuing that pre-approval. So it's very quick. Yeah, it's usually if we get a loan application before noon and the numbers look good, we can get you a pre-approval before 5 p.m. So.
Do you need like a repair analysis with that?
Yep. So our pro forma includes, and right now we made it even easier. So our online loan application will ask you questions: how much is the purchase price? What is your estimated construction cost? If you're going to be selling the property, what you think you're going to sell it for. If you're renting it, what you think the rents will be. So it'll ask you a series of questions about the project numbers. And then it will produce a pro forma on our end that we'll review and send back to you to kind of double check, are these the numbers that you intended? And if they look good, then we can move forward. If you want to change some of those numbers and give us a little more detail, then you have the opportunity to do that as well.
And my last question is, the 50% of the cost, does that include transfer taxes and insurance?
Yes, so we do estimate a 5.14% sort of closing costs for the transfer tax, title, and other closing costs. So, yep. Okay. Yes.
So I want to make sure I understand you clearly. So if you take the Jumpstart Germantown training program and then you use the loan you can purchase property all across the city. That does not pertain just to Germantown.
Correct, and you don't have to take the training program to use the loan. So yeah, and if you're a graduate of any of the programs in Philadelphia, you'll get that 0.5 point discount. So if you've already gone through Tioga's Jumpstart program or Southwest, you would still get that 0.5 point discount. But yeah.
Are there any other trainings aside from Germantown coming up?
I don't know the dates, but my card is on the table back there, and we can send you the contact info for all of those other Jumpstart training programs. Oh, okay. Yes. Yeah. So yeah, there's North Philly West. There's about 6 in the city, and then there's Norristown as well. So with all of those, there's usually a training program coming up soon. Yeah. So, yes.
You mentioned something about if you own the property 100%, can it be like a separate property? Not the property I'm going to rehab?
No, it would need to be the subject property that we're looking at that you would need to own 100%. Yes.
Is there a limit on the assets or income of the applicant?
There is not. No income limits there. All right. I think we are wrapping up. Any last question? No. Okay. Well, I thank you all so much. I have a card back there, and jumpstartphilly.com for any. Yeah. No. Just sorry. And jumpstartphilly.com.